2025 has been anything but predictable for crypto. From price surges to sharp corrections, a wave of institutional momentum, and game-changing regulation, this year's first half has reshaped the digital asset landscape. In this Tokenize Academy episode, we're diving into the key market movements, milestones, and what they mean for investors heading into Q3 and Q4. Let's break it all down. Section 1. Q1 Recap, Metrics and Market Move. Let's start with Q1. The crypto market started strong, but soon hit turbulence. Total market cap peaked at around $3.8 trillion in mid-January, right before Donald Trump's inauguration. But by the end of March, we were down nearly 19%, sitting closer to $2.8 trillion. Bitcoin dominance climbed to over 59% as altcoins fell behind. BTC itself dropped by nearly 12%, while the Nasdaq and S&P 500 followed suit. So where did the capital go? Surprisingly, not entirely out of crypto. Instead, average daily trading volume fell by 27% and volatility picked up. But not all segments shrank. Stablecoins hit a record high of $218 billion, even as DeFi lending contracted sharply, down more than 21% for the quarter. Meanwhile, on-chain activity and VC flows told a different story. Nearly $4.8 billion was poured into crypto projects, up 54% from Q4 2024. Binance's massive $2 billion raise led the pack. The message? Under the surface, capital wasn't fleeing. It was repositioning. Section 2. Q2 Recovery and Institutional Rotation. Q2 flipped the script. Bitcoin surged back, gaining 30% in 3 months and stabilizing just below $110,000. Strong ETF inflows, positive macro signals, and institutional demand kept momentum high. The biggest institutional signal came from BlackRock, which added nearly 8,000 BTC in Q2 alone. That's a major vote of confidence from the world's largest asset manager. Trump's executive order in March added fuel, creating a 200,000 BTC strategic reserve and pushing crypto policy into national strategy. Globally, regulation caught up. The EU's MiCA framework came into effect, streamlining crypto licensing across Europe. Pakistan launched a state-backed Bitcoin reserve and allocated power for AI and mining hubs. Meanwhile, spot Bitcoin ETFs matured from headlines to cornerstones. Crypto is no longer an experiment. It's part of the institutional playbook. Section 3. Altcoins, Themes, and What's Brewing. Now, what about altcoins? Altcoin market cap, excluding BTC, dropped about 41% in the first half, falling to $950 billion from December's $1.6 trillion high. But here's the twist. AI tokens, res-taking protocols, and post-halving narratives are gaining steam. Thematic investing is making a comeback. The idea? Not all altcoins are equal. Capital is flowing into tokens with strong narratives and real utility, especially in AI and decentralized compute. And there's a macro twist too. Stablecoins are now impacting US Treasury yields. Tether alone holds over $98 billion in T-bills, cutting short-term yields by as much as 24 basis points. Crypto isn't just part of digital finance anymore. It's starting to influence traditional markets. So, what have we learned? Q1 exposed cracks in the market's surface, volatility, contraction, and structural shifts. Q2 showed resilience and maturity. Bitcoin bounced back, institutions leaned in, and regulation provided a clearer path forward. We're watching a cycle evolve not just in price, but in how crypto integrates into global finance. And with altcoins gathering steam and new sectors gaining traction, Q3 and Q4 could mark the start of a new wave, especially if interest rate cuts and macro catalysts align. Make sure to subscribe to Tokenize Xchange so you don't miss the next big inflection point. And if you want to trade on the go, download the Tokenize app and explore tools like DCA, Express Trades, and our brand new Tokenize Y feature to join the conversation and grow your portfolio with confidence. This is Tokenize Xchange. Stay curious, stay cautious, and we'll see you in the next one.